All right. Good morning, everybody. It's Tuesday. The big thing today is going to be retail sales, but I mean, we gotta be able to balance that in the understanding that, it might be the biggest thing today, but it's not a big thing, right? When you're newer to trying to determine what is going to be an anticipated big thing or not, you can use FX Street. You don't need an account, but it helps. Um, if you make an account here to access their free stuff, just give them a spoof email address because these guys will harass you with emails. I'm not logged in. You don't need to log in to see this. And always try to read this little excerpt up here at the top, because a lot of times they'll talk about the Dixie, the DXY, the dollar index, and it's useful, right? It's helpful to get that little bit of insight. Then they gauge the anticipated impact of the economic event in 3 different color scales: light, medium, and heavy, or light, medium, and dark, however you want to say it. Either way. Now, it's not telling you that it's going to be an impactful event, just that historically it has been volatility inducing, meaning you're likely to see a pretty good size move, especially if the numbers miss. And that's a big deal, right? Always look at what the consensus estimate is and see if it's in line with or how far away it is from the previous. That way, when you do get the numbers, if it's way off, you're already anticipating the likely move. Even without any of that, just knowing that it's going to be impactful can assist you with standing aside, not getting in the way, not taking a trade, and then 30 seconds later having the market explode and full stop take you out, leaving you sitting there wondering, what the heck was that? And I see it every day. We get a big move and somebody will say, what just happened? What moved the market? You didn't know that was coming? Dun, da, da, da. China's still in focus, and they did a rate cut. So, if you think about when the US does rate cuts, it's just to kind of put that in focus. It's usually when things in our economy aren't going well and they're trying to stimulate the economy. The Fed will cut rates. China is in such a bind right now. They're trying to stimulate their economy that they did a rate cut. So we're over here still increasing rates, trying to manage this inflation that they think is creeping back up again. And we're still looking, for that mythical neutral spot so that we can get just slightly past neutral into mildly restrictive territory, just to use, the Fed's target right now. That's their target, by the way, mildly restrictive. So we're raising rates, they're cutting rates. Now we're looking at another rate hike for September at the Bank of England. So England as well is still raising rates, or is anticipated to raise rates. So the reason we're down this morning, if we needed a reason to put our finger on, it would be fears of an economic slowdown, a global economic slowdown due to a feared recession in China. If China goes into recession or stagflation and it starts to build contagion around the world, that's what has the markets spooked or rattled this morning. It's important to recognize that for a number of reasons, but one is that there's no tangible thing to point at, right? It's just mood or sentiment, and sentiment can change real fast. It can go from, fear to greed really quick. The analogy that I usually use is, unfortunately, Boeing when it had airplanes falling out of the sky. It killed entire families. You don't get to just shrug that off, right? And it affected Boeing for years. That was a tangible thing. This is nothing more than mood and sentiment, and it can instantly change. So we're looking at what's going on around the world here, and we can sort them by their highest and lowest. Japan is down the most, Hong Kong behind that. Then we start getting into US markets with the Dow Jones being down the least. Or excuse me, that NASDAQ, not the Dow. The Russell is down the most out of our markets. So it's the Russell, the Dow, the S&P, and then the NASDAQ down the least with those mega market cap tech stocks. Now, I remember last week when we were kind of grinding to the downside in this nice, clean, controlled sell-off. It was those value names that really fell the least, right? And it was the growth names that got whacked really good. Think about your NVIDIA, Apple, Amazon, right? The FANG names got hit worse than your quote value names. So in a down market, everything's going to go down. But we want to focus on what's going to go down the least, especially for the long-term buy and hold. It kind of looks like a full schedule, but it's really not that bad. 8:30, 10 o'clock, and 11 o'clock. The 11 o'clock is an additional auction. It seems like I'm the only one that ever mentions these things, but they hold weight for me. They also tie into my theory that watching the clock is one of the most valuable things you could do as a trader. The government is lazy, and that includes governments around the world. They will put out data on a quarterly basis. So every 15 minutes, 30 minutes, 60 minutes, there is the capacity for another economic data point to drop. And it might be some vague foreign thing that you've never heard of before that can move markets. And rather than trying to go out and hunt them all down, because this is not all of them, it's only a fraction of them. These are only a fraction of them. They're not all of them. And these here too, only a fraction of them. We don't have them all. We could go digging for them and hopefully find most of them, but why go through all that effort and then still trying to figure out which one of those might or might not be impactful? We know that they're going to come on a half hour, a quarter hour, or the full hour. So all you got to do is anticipate the bigger ones and keep your eye on the clock, especially if you're using a tight stop. You know, you're in a small account in the futures, you're trying to grow that small account out. You don't want to take a trade 2 minutes before a 15-minute candle close with a tight stop, because you're very likely just going to get stopped out. It seems too easy, right? Run some volume analysis and you'll see that uptick in volume. And it's not every single 15-minute candle, right? Because not all economic events are going to bring the pain. But the uptick in volume that you will find will happen on those 15, 30 hourly. So, you know, just simple little things like that can save your little account from taking a stop out that you didn't need to take. What we have so far this morning, just to kind of get some perspective on things, we are back below the weekly pivot point. We managed to get through it yesterday. And after a lot of pain and angst, we finally broke out right near the end of the day. It looked like things were going pretty good. Now we're back below the daily and the weekly pivot point. Being below the daily pivot point doesn't hold as much weight as being below that weekly pivot point. when we're below the weekly pivot point, we carry this bias of a negative market, a market struggling. So, if we were a long ways away to the downside, if we were way down here below that weekly pivot and we were trying to go back up, then we'd be, primary downtrend, secondary uptrend, and we'd still be bearish or bearish under caution, trying to get back above that. But right now we're not below it trying to get back up. We're still below it going down. Primary and secondary trend bearish. Bias also bearish. We're underneath the 10-week, also bearish. And we've got a line in the sand right now of last week's low. We really need to hold that level. We've still got our 50% mark, 45, 57, 75. That is the measurement of the last big candle. We always want to follow the direction of the last big candle, and right now that is bearish. And until we get at least 50% through that candle, we're going to maintain that bearish bias. To even get to that 50% level, we've got to get through the previous week's high. We have to hit the entire ADR full. We've got some voodoo lines in the way and the 10-period daily moving average, or 10-week, excuse me, not 10-day. Both the 10-day and the 10-week. So we got a lot. It's a lot to deal with. Looking at the volume, it's kind of nice to see this, right? Now, remember, Europe, France, a couple other places were closed yesterday, a banking holiday. And some of this elevated volume this morning could just be them trying to get caught up. I don't really like that answer, but when we look at volume like that, we got to try to put a narrative to it. So that's one narrative that we could bring in, that this elevated volume that we're seeing is just a part of that. I like that narrative because if it was fear, we would be seeing some market maker move this morning, and we don't have that, right? So we just have the elevated volume. It's not too extreme. If we had gotten closer to 200 down here, then I'd be more concerned. But this level of volume should be something that we, take note of, be aware of, approach with just a little bit more caution. Usually for me, that just means I reduce my position size a little bit. Instead of taking 8 and 12s, going to 4s and 6s. $10-day, 30-minute volume profile. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. As I had discussed with you yesterday, we were going to lose that lower volume that was continuing to give us a skewed profile. And now we have more of a classic B shape. We've still got a little bit up here, but that's going to fall off through the morning, right? So as we get through Tuesday here, we're going to lose this Tuesday volume. And then we will have a real solid D shape, right? With a little bit of tail up there at the top, but we'll even lose that through Wednesday. The point of control is overhead. And if you look at the TPO, which is the blue profile here on the right, we do have that classic B shape. Any drive to the upside is going to have to work through that point of control, right? And if we get close to it, it will start to form like a magnet and we'll gravitate to it. We don't have a VPOC to carry forward from yesterday. We had one, but it got taken out at 3 o'clock this morning. So now we don't have one. Due to the shape and the structure of yesterday's price action and kind of putting it together with Friday's price action, we've got a very clean, clear range that we can plot and measure out both directions. We're also forming now into an IX10, which is kind of nice. Gotta love it when you got some patterns to everything. So let's start with the IX10. If it was inside this really big candle back here, it wouldn't be as exciting, right? When you have a range bound market and you're trying to play a compression breakout, you don't want a really big candle. You want a really small candle like we had back here. Multiple days inside of a very small range generally end up with a pretty good sized move that can last for days. So if this candle that I have marked down here was the IX10, it wouldn't be that exciting or relevant. But instead, we're dealing with a much narrower range. And it's not a perfect range. It's not clean and pretty as we would like, because yesterday we broke out and drove to the upside and closed at the high of the day. Now we're back down inside. So that kind of just broke things a little bit. So it's not perfect, but we do have a nice range down here that is going to continue to build if we stay inside of this. So that's what we want to start keeping our eye on is, are we going to stay inside of this? And for how many days, building up that energy for the move. Because we have this range that is so clean and clear, we can measure it. Just like all the textbooks talk about, you can measure, a rectangle, a range, a head and shoulders. Every candle pattern out there can be measured. And then you just project those measurements by 50% and by 100%. If we were to break to the upside, it's a big if, our targets would be 45.32 and then 45.56. But we can also break to the downside. So same measurement, just going in the other direction. $44.34 and $44.10, which happens to be the cog line, $44.11, and $44.32 is a cog line, really close. Close enough that it would just gravitate into it, right? $45.32 cog line across the high. Not a coincidence. Maybe it's a coincidence. So just like that, we've got some levels, right? And it fits right into the textbook. We didn't have to do any, crazy making stuff up and trying to, oh, there's a phrase for it. When you pick your data, form fit. We didn't have to form fit anything, right? So one step at a time. We need to consider some unfinished business. When price action catches traders unaware and makes a sudden fast move like that, very often we'll go back and close the gap. And I know that you don't see a gap, you see candles. But one, we consider that a place of unfinished business. So price wants to go back there to get things finished. And then two, the pace of the drop, the sudden, very fast move to the downside would kind of generate that unfinished business, the gap that we talk about at CPI non-farm payrolls day, PPI, those mornings where we get that big explosive move and we play a gap close play. But this is the same generative image. It's the same thing right there. So we're going to consider that a gap that needs to be filled. Unfortunately, that doesn't really hold a lot of weight because we've already got a lot of other gaps that need to be filled. And this just gets added to the list. But I would add it to the list. We had the same kind of move yesterday with that 2-bar push up, and we had to consider that a gap that needed to be filled. Funny enough, it created a gap trying to fill that gap, right? Same thing happened. So we came down, we filled it, but then that one needed to be filled, and we came back up and filled that. Like I was talking with somebody yesterday, the market can try to correct itself and then create another imbalance by trying to correct itself, which created another imbalance, which needed to be corrected. And it's like shaking a boat really fast, a small boat, and waiting for everything to settle down. And if you don't, the more you try to steady it, the more you just shake it up. I guess analogy would be the same with the motorcycle. Another measurement that we haven't talked about yet is measuring the entire drive. So from yesterday's highest point and lowest point, or today's highest and yesterday's lowest, that'll give us a half back point. You can see the market already responded to that level. Once we broke through that 50% and it tried to come back up and get through it, it couldn't multiple times. That level held, that 44.91. 44.91 is very likely a pivot point you've heard multiple times this year from trading ticks, from spot gamma. I believe it was even covered a few times in tier 1 alpha. 44.91 is a level that if you haven't heard about yet, you're going to hear about it more often, right? That one keeps coming back. It's not a coincidence that it lined up perfectly here. I didn't know it was going to be there. It just happened to be the 50% level. All right, so the halfback has already been tested and failed. We're continuing to march now to the downside, but it shows the validity of that level, right? And definitely want to mark it. You want to know where it is. So 44.91. I don't need to necessarily mark that one because for me, 44.91 is already a level of concern, but you could mark it if you didn't have it yet. And we'll give these a few more minutes. And we'll take a look at something else first. So we got US dollar Japan above that 145, and that's a level of concern we talked about yesterday. There's no reason to continue to pound the table there. Just realize we are above that 145. We tangled up with my pivot point yesterday at 145.90. This is a really big deal, and we're still up there. And as long as we're holding above that level, the clock is ticking for when they're going to come in and run their intervention. It's not if they're going to run the intervention, right? It's when. And the thing is, with their new governor, we just don't know, right? There's so much about the situation that we don't know, and this new governor that we don't know. There's been a lot of talk that he's going to be the change agent, which is a really big deal. We're talking about a decade of something ending. So keep your eye on US dollar Japan. We really need to get this back below that 145 level, back below the quarterly level, but it needs to be orderly and systematic, right? No big sweeping fast moves. US dollar China, same thing, just continuing to drive to the upside, and that still looks bullish, right? So it doesn't look done even a little bit. We need to see this back off, level out, provide some sort of topping pattern, and start heading to the downside. But again, no big moves, right? We don't want falling out of bed or anything like that. And the 10-year above 4.2 this morning. This is going to cause pain around the world. And as long as we're above that 4.1, it's a slow boil, right? I mentioned that the other day, and not an hour after I was done with the morning briefing, I seen that in a headline. So, from one point of view, hey, at least we're on the same page, right? And then from the other point of view, maybe they were listening to my morning briefing and they wrote their article afterwards. Yes, not likely, but whatever. Made me feel good. Either way, because it shows we're on the same page. So the dollar took that rejection on the quarterly level yesterday and is holding below that 103.5. And we're getting this disconnect. Actually, we're continuing this disconnect that I had talked about last week. And this is one of the things that is causing me the most. It's not anxiety, but it is the one thing that's caused me the most distress. We have this 10-year continuing to push and drive and test the highs, and the dollar is now deciding to do the opposite. So it's not working hand in hand with the 10-year anymore. We've had that relationship for so long now that when it's starting to come apart, it leaves me anxious with what now? How are we going to gauge this, and what's the trade that we get out of it? I don't have an answer to that yet, by the way. So we do want to see the 10-year come on, get back down into, at least below the 4.2. That'd be a great start, but it, in the bigger picture, it needs to get below 4 again. Just no big, fast, sudden moves, right? Nice and easy. That's kind of what we're looking for. Just a nice, calm topping pattern, and then a gentle move back down. We can't rally in the S&P and the NASDAQ if this continues to go to the upside. So it really comes down to that. There can't be a rally, but, and we've seen the start of this discussion last week, this can be the trigger for the save a hoe, right? The little, they're going to come in and, the PPT comes in and fixes everything. So what we used to do before COVID was we'd have these 5 to 7% pullbacks in the market. And that's when everybody would reload and buy the dip. And you'd get, 2, maybe 3 a year. And you really took advantage of those pullbacks. It's kind of the sweet spot. And it just trained everybody into that buy the dip herd mentality. So what I've zoomed in to here is the 2018. This is the year that I started trading. Wasn't that long ago. That was just a little bit different. That was a volatility box. And then this really big sell-off was a little different. And they actually had an intervention here where Powell and the banks had this discussion like on Christmas Eve or really close to it. They came in and played save a hoe on that one and flipped the script right back around. That one's a little deeper than normal, right? I don't remember what that one was. Yeah, that was a 20%. That was a little steeper, but it was also because of that situation in the middle. So other than that, we just had these really good 5 to 7% pullbacks, and they would flip everything over and run it back in the other direction, right? And that was the go-to, just these good little pullbacks. And then things, we had COVID and everything else, and the whole structure broke, and we had this bear market, and now we're trying to kind of reset the game again. So the good solid buy the dip levels. Having the 10-year above that 4.2 gives them the cover they need to play that save a hoe card, to come in and just, they don't have to buy anything. They don't have to trade anything. They just have to come out and start talking about something. And so you want to think about Jackson Hole. You want to think about what else do we have on the horizon where they could come in and without cutting rates, because they're not going to do that. But what else could they do, and where could they do it that would offer them a chance to flip the script on this market, drop that 10-year down? Either through Japan or through Jackson Hole. What else do we have, right? There's those two for sure. Maybe something in Europe, but I think it's going to be Japan. And there you go. So we got two major things to watch for. As long as we maintain these high levels in the 10-year and we continue to drive and push higher, you're not going to have that reversal and rally out in the S&P and in the NASDAQ. And look at these moves to the downside. That is just nice, clean, controlled. It's not chaotic. It's not, massive selling. And the VIX is a little elevated because they actually have something that they need to protect, right? When everybody was short, they didn't have to fear a market going down. And then when all the major firms were mostly flat or were out of their major positions, they didn't have to cover, right? You don't need insurance when you don't have a book to cover. But they've been building out that new book through 2023. And now they own enough that needs to get covered. And now we're starting to see coverage being bought in the VIX. So the VIX wasn't broken, right? Remember 2 years of articles saying the VIX isn't working? It wasn't broken. There was just no activity in the window that it was watching. And now we're starting to see a little bit of activity in there. Should be a fairly simple day today. We want to maintain the structure, maintain this trade pattern, continue to roll on the idea that we're going to go down just back to the previous level. And one of the comments that I made yesterday afternoon was when someone said, you think we're going to go back down to those lows yesterday? And the answer was no. All they got to do is hold this level, right? They didn't need to sell it off. They didn't need to break out yesterday. All they needed to do was just maintain this level up here. That's all they needed. Well, today, all we need is to stay above Monday's low at the moment. At the end of the week, as long as we maintain higher than Monday's low, they're going to look at this and say it was an up week in the market. We got two lows to deal with today. Yesterday's RTH low. And then yesterday's Globex low. 44.69. And then 44.65. Then we'll deal with Friday's low, 44.59. I gotta say, if we get close to 44.59, we're very likely going to go to 44.50 because it's another one of those gamma levels, structure levels. It'll pull us there like gravity. We get that close, we're very likely going to just go ahead and do it. I was really surprised Friday that we didn't go to 44.50. Nat gas is down the most, not much of a surprise. KRE behind that, so regional banks are getting whacked pretty good this morning. And then regular financials behind that with energy, and then call a timeout there. That's all the reflation names or reflation space, all right? KRE, XLE, XLF, XME, I'm surprised isn't in there, but it likely just isn't getting the flows yet this morning. So reflation's getting whacked. Then we've got the China ADRs, got bonds. And remember, bonds, they really needed to step up and defend things yesterday, right? That was like the call, the mantra. Where's the bond bulls? They needed to come in there and play save-a-ho. And they did a really good job yesterday. But it ain't sticking. Let's look at this on the bigger picture. Kind of give it a broader chart. So we are using the ZB, but you don't need to necessarily use this. After 8:30, you could bring up TLT, or you could look at one of the other, say like the 5-year or the 10-year bond. I'm really comfortable with the 30-year. I like this. It is notional fraction. So, don't stress on it. There's 32 of them, so 16 is half. 122 over 122.16 is your half point right there. And so there's your half, there's your whole numbers. Just keep it like that. And of course, half of 16 is 8, so you can do quarters. It's that easy, right? Nothing to it. So this morning, we've got that line from August 4, and below that, we're all the way down at 118. There's nothing else down there to catch us, right? That's basically 119. And that's basically 118. So close enough. This really needs to be defended. They really need to step up. Now, looking at it on the daily, we've got a classic double bottom setup. And liquidity resides on the other side of the pivot. It's not a good double bottom if it doesn't go through that line in the sand. Which is kind of why yesterday didn't really ring true, right? When we came down and we got close. That's called front running. They'll start coming in and buying, worried that they won't get their entry. So they just jump in early, front run it. And there's times when that'll happen and it'll just take off. But that's different than deliberately trapping bears and then squeezing them and popping it and ripping it to the upside. They're two different positions, two different plays. So the front running didn't work, or those that were worried about missing their play, they have their position there. That's fine, great. But liquidity still resides on the other side. So if this is going to be a classic bear trap double bottom, it has to trigger. It needs to get down into that lower level and be convincing Otherwise, the bears aren't going to take it, right? It needs to be convincing. And speaking of convincing with a big bear trap, how about that one? On the right side is a weekly chart, and you can see that 122 level and the bear trap, which is now sprung. But at some point, it goes too far, and it's no longer a double bottom bear trap. Instead, it's just a breakout continuation to the downside. When is it only one, and when is it something else? They teach us to measure range, right? So if we just go out and measure range, plot that and level it at 50% and 100%, like we talked about earlier, we've got the range measured. And even if we want to do, say, eliminate all of that wiki stuff, right? And just take it from candle bodies, then we're still past the 50%. And we're more likely going to go to that 200%, right? So no matter which way you cut it, there's still measured move to the downside. It's a long ways though. On the weekly, that's a huge measurement. On the daily, we'll just focus on these 1828 and 1812. So one of the things that ties into all of this is how fast price moves in here. We don't want to see these really fast, crazy Ivan kind of moves. We want nice, controlled, easy, systematic selling, right? No fear and chaos. Just like, let's just work our way down to those levels. If it starts to pick up speed, then look for the markets to really kind of start to react all at once. The algos will kick in and you'll see it across the board and in everything, that rising tide and falling tide scenario. All right, so refiners are down the worst. Everything is down altogether except for the indexes. They're barely just flat to mildly up. I mean, like, you know, barely, almost negligibly up. So they might as well be flat. Refiners, banks, pot's down 1 1/4. Crypto down more than 0.75%, but less than the EVs and steel. Kind of getting a little bit of that move back from the news yesterday and the China ADRs. All right, so we don't have the S&P 100 on TradingView. We just use the weight and the filter and knock it down to as close to 100 as we can. These things will change color when price has moved more than 0.5%, which is great because that's my benchmark for even bothering to look at a stock. We can see all of the fangs by the size of the box, right? The bigger the market cap, the larger this box is going to be. And so those fangs stand out. Tesla, Meta, Google, Microsoft. NVIDIA. NVIDIA's up 1.25%, but Apple's down, Meta, all of these, right? All of the FANGs except for NVIDIA. It's not a semiconductor thing either, because we can see a lot of these other semiconductors, they're also down. So it's just NVIDIA, which did get a price bump this morning. There was an analyst and a firm that came out and put a new rating on NVIDIA. AMD also is up. Not as much, but it's up as well. So we got semis. That's not enough. Well, I thought they would have done better than that. So we got Home Depot, and really we're not seeing anything out of Home Depot. It's not yet. Lowe's isn't really acting off of that Home Depot earnings either. I mean, it looks good that NVIDIA is up so strongly this morning, but it's just on an analyst recommendation, and a lot of those are manipulated, right? A firm will want to get out of something and they'll just, hey, hype it up really good in the pre-market. And then, everybody goes in and starts buying it, and the institutions are happy to give you their position and get out of it. So I don't know if that's the situation here, but it's usually the first thing I think of when I see that a company gets an upgrade like that. It's not like new information came out, right? When we did have new information and NVIDIA went up, for like a month, well, we had new information, but we don't have new information this morning on NVIDIA. So why the bump, right? Analyst rate change. It's just a run up into earnings. So they were talking about next week. It's the run up into earnings. So we very likely could complete that TRB setup, get into the 460s, 480s before the next or before that earnings event happens. It's the ramp up, right? AMD's actually down this morning. So I don't know what's up with TradingView. Nope, it's back down. So it must be just wobbling around. AVGO is now positive. No, it's not. We can see the bid and the ask is 851 and 849. So I'd say TradingView is just having a little issue this morning. But that's why you want to check your scans from multiple places. So shorting the banks as a continuation, playing the reversal off of yesterday with all those FANG name pops that we had. All of them moved nicely yesterday. The discussion was that we were likely bouncing off of a support level and that we were going to rally up into resistance before rolling over and continuing that move. So if that is the case, then we found that 20. We have the 20 period weekly here on Microsoft for an example. We get a little bit of a rally before rolling over and continuing that move to the downside. If you're bearish, that makes perfect sense. I'm still looking at this as a nice TRB setup. And then we need to build a base. And for that to hold true, we basically on the weekly need to close higher than that low that we have here. 318, 319, something like that. As long as we're continuing to close on the week higher than that, then we can dip down below it, cause a little grief. We need to build this base, and we're not even talking about a breakover and a breakout yet. We got a long ways to go for that. Now, LRE says we can buy along these lows, and it would be the least amount of risk dollar-wise would be to do that. But it is riskier to do that because you don't have a signal to go long. You're just buying at those lows because it's the least amount of risk. For Microsoft, 322 is the 50% mark of yesterday, and we're already below that number. So if we are going to be bullish and try to carry that momentum upwards, then it needs to close above that 322 by the end of the day today. Otherwise, if it closes below that level, it opens up these lower levels and we can come back and touch 320, 319, right? We would have every right to come back down and touch those levels if we close below 50% today. It'll be the same thing with the other ones. We don't really necessarily have to go through each one of them turn by turn. Apple's down this morning, has the same base. It doesn't have such a big candle to measure, but you know, there is a candle to measure yesterday's level. We're already below it, but 178.5. Oh, excuse me, we're not below it. We're still above it, just barely. Bid in the ask is at 178.59 and 62. So we are above it just barely, but we need to close above it by the end of the day so we can get below, come back up. Either way, if we can close above, it'll just be a continuation of this base that we're building down there. And we are still underneath that 20 period weekly moving average, which is a really big deal. Now that we're underneath it, it's going to be hard to get past it and back through it again. But this is a good reset for, I mean, look how dominant that was. It needed to pull back at least a little bit. But at what point is the pullback too much? I'd say we're there. Anything more than that, and you'd have to consider the whole thing structurally broken, and that we're going to aim for a half back 162. Not yet. We have to let the week play out. So that's what I got, guys. Be careful, be safe. Try to hit the things that aren't down the most, right? It's easier to short when you're not shorting from the hole. I'll see you all tomorrow.